Well, hello Dragons, and welcome to this instructional video for Lesson 8, Part 2, the Federal Reserve at Work. The main idea behind this economics lesson is the Federal Reserve System provides a number of banking services in the U.S. economy. With that in mind, by the end of watching this video, you'll be able to identify services the Fed provides to banks, describe ways the Fed serves the federal government, and explain how economists measure the U.S. money supply. Now that the outcomes for this lesson have been shared with you, let's get started. What does the Federal Reserve System do for you? Directly, the Fed does not provide many services to you, for it is not designed to provide services to individuals. Instead, the Fed serves consumers like you indirectly by providing services to commercial banks and to the federal government. As you know, one of the Fed's main roles is to supervise and provide services to commercial banks through its 12 Federal Reserve District banks. Although you cannot open a checking or savings account at a Federal Reserve Bank, the banking services it provides make transactions at your local commercial bank easier and faster. What Fed activities enable these improvements to commercial banking? The Fed oversees the flow of money between member banks and its district banks. It does so mainly by clearing checks and by lending reserves to commercial banks. Checks are used in millions of financial transactions every day. In fact, Americans write about 42.6 billion checks every year. The Fed keeps track of these billions of monetary transfers through the service of check clearing, which is a method of crediting and debiting banks' reserve accounts, and in turn, checking accounts. How does check clearing work? Suppose that you decide to buy a pair of running shoes at Foot Locker. Although the shoes are yours as soon as you write the check, it takes a little longer and several more steps to transfer money from your bank account to the stores. When you need a loan, you might visit a bank such as Glendale Federal Bank in California or Chevy Chase Bank in Maryland. When a bank or other depository institution needs a loan, it contacts its district Federal Reserve Bank. Because their depositors may make large and unexpected withdrawals, banks often need short-term loans to replenish their reserves or supplies of cash. Federal Reserve Banks loan reserves, usually for periods of 1 day to several weeks. Most Federal Reserve loans are sought for seasonal factors, natural disasters, and financial emergencies. Seasonal factors are the fairly predictable annual events that deplete reserves in banks. For example, the cash reserves of small rural banks are often reduced during the spring and summer planting and growing seasons, when farmers withdraw their cash and apply for loans to pay for farm operations. Similarly, gift purchases during the December holiday season typically involve large withdrawals, and disasters such as floods or hurricanes naturally spur demand for loans. These withdrawals reduce cash reserves in banks. In these cases, the Fed often lends money to depository institutions to replenish their reserves. In 1973, the Federal Reserve also established a seasonal credit program to help small banks, in particular, meet these swings in demand. In financial emergencies such as a recession, the Fed serves as a lender of last resort by making emergency loans to commercial banks. Under special circumstances, a Federal Reserve Bank also may extend loans to corporations and individuals who are unable to obtain funding from other financial institutions. To receive a loan from a Federal Reserve Bank, financial institutions must meet strict qualifications such as collateral requirements. In deciding whether to make such a loan, the Fed analyzes the effect of the emergency on the national or regional economy. It then makes only those loans considered vital to the economic well-being of the region or nation. All institutions that borrow often from the Fed become subject to financial review and close supervision by the federal government. What is your budget? Think of how much money you can earn and how much you can spend every year. Each year, the U.S. government raises and spends more than $4.1 trillion. The Treasury Department and the Fed generally work together to manage this vast sum and the government's complex financial activities. What role does the Treasury Department play in this task? Think of the Treasury Department as the U.S. government's banker. The Secretary of the Treasury is the chief financial officer for the government and ensures that the U.S. Treasury pays all of the government's bills. Through the Internal Revenue Service, the IRS, and the U.S. Customs Service, the Treasury Department collects taxes. Through the U.S. Mint and the Bureau of Engraving and Printing, it produces coins and currency. How does the Fed work with the Treasury? The Fed's role in managing the government's financial activities consists of providing the following services: serving as the government's bank, supervising the Fed's member banks, and regulating the national money supply. If the Treasury Department is the government's banker, then the Fed is the government's bank. That is, the Fed's banking services to government are similar to those that banks provide to individuals. How does the Federal Reserve act as the government's bank? First, the Fed serves as the depository for federal revenues. Government funds are deposited in Federal Reserve banks by the Treasury. Second, the Fed holds a Treasury checking account on which the Treasury writes checks to cover tax refunds, Social Security payments, and all other government payments. Third, the Fed records the deposits and withdrawals of federal funds and conducts the purchase and sale of government securities such as Treasury bills. Finally, the Fed advises the legislative and executive branches of government on developing a coordinated economic program. The Fed also functions as the banking system's watchdog. Each of the 12 Federal Reserve banks has a staff of bank examiners that supervises the financial activities of member banks. These examiners monitor loans and investments and conduct reviews of bank records. All financial depository institutions are required to maintain cash reserves to guarantee that depositors can withdraw their money when needed. The Fed monitors the reserves held by member banks, ensuring that these banks have enough money to meet withdrawal requests. In addition, the Fed regulates bank mergers and the chartering of bank holding companies to ensure that individual commercial banks do not gain too much power over the U.S. economy. The Fed's third key function is the regulation of the nation's money supply, or the amount of money circulating in the U.S. economy. As noted in Lesson 7, the United States relies on a single form of currency. This money is produced in two forms: Federal Reserve notes, dollars, which are printed by the Treasury Department's Bureau of Engraving and Printing, and coins, which are generated by the U.S. Mint. The 12 Federal Reserve banks distribute this currency. New currency is put into circulation for two major reasons. One reason is to replace old and worn-out notes, which eventually are destroyed. Banks regularly ship worn-out notes to their district's Federal Reserve Bank in exchange for new notes. The other reason is to increase the amount of money in circulation by expanding the pool of cash that the Federal Reserve banks can loan. How does the Fed increase or decrease the U.S. money supply? On behalf of the entire system, the Federal Reserve Bank of New York buys and sells U.S. government securities on the open market. Trading in securities allows the Fed both to increase or decrease the money supply and to provide the government with the cash it needs to finance public goods and services. The process by which the Fed trades securities is discussed in greater detail in Part 3. Before taking action to regulate the money supply, the Fed must determine how much money is circulating in the economy. Economists, those working for the Fed and elsewhere, have determined several ways to measure the nation's money. The two most common measures of the money supply are called M1 and M2. Other measures are called M3 and L. The narrowest, as well as the simplest, measure of the money supply is M1. Economists who prefer to use M1 believe that the money supply should consist only of funds that are easily accessible in an actual circulation. Thus, M1 counts all the currency in circulation, the value of all travelers' checks, all checking account deposits, and similar accounts in financial institutions. Checking and checking type accounts represent nearly 63% of the M1 total. In 2022, M1 totaled more than $20.7 trillion. A broader measure of the money supply is M2, which totaled more than $22 trillion in 2022. Some economists insist that M1 does not include all readily available funds. They consider M2 to be more accurate because in addition to the money counted in M1, M2 includes money market accounts, money market mutual fund shares, and other savings deposits, such as certificates of deposits, in amounts under $100,000 that allow people easy access to their funds. M2 also includes money deposited in savings accounts. The development of automated teller machines, or ATMs, has allowed savings accounts to serve some of the same purposes as checking accounts. ATMs allow depositors instant access to their savings accounts, turning those savings into spendable funds. Other economists believe that even M2 fails to accurately measure the money supply. They rely on either M3 or L, which are broader measures than M2. M3 includes the money in M2, as well as all large time deposits, such as CDs, valued at $100,000 or more. L, meanwhile, includes those M3 amounts as well as savings bonds, short-term Treasury securities, and other types of near money. However, since the early 2000s, the Fed no longer counts M3 and L. So that's the way it is for Lesson 8, Part 2, the Federal Reserve at Work. At this point, you should know that the Fed provides services to banks that include the overseeing the flow of money among member banks and making loans to commercial banks, and the Fed serves the government by managing its financial activities as the government's bank, supervising member banks, and regulating the money supply. Don't forget to subscribe to my channel to have the entire catalog of economics videos available at your fingertips. Click the subscribe button and then click the follow bell to receive notifications as to when the channel is updated. Thanks for watching, and I'll catch you in class, Dragons.